Okay, good afternoon, everybody. Welcome to the Polaris Trading Group's PTG University Wednesday Workshop Educational Series. Today's April 30th, 2014. And today's workshop, we're going to focus on one of our new trade setups called the Stacker. And it's a trend shifting trade setup. Okay, so we'll go over the components here. And that slide comes up. Okay, so the stacker components, all right, simply what it is, it's a specific relationship between three exponential moving averages, and the ones we use are the 13 EMA, the 34, and the 89. We also use the 233, and simply that's used to define the next higher degree trend condition. So we want to make sure that primarily we're using the stacker on tick charts, all right, so which is a very micro look at what's going on, all right. So we need to be aware of what the larger degree picture is, all right. So that's that 233, and you'll see it in the charts, all right. We always want to trade in the direction of the primary trend, which is we use as the 89 EMA. And then we use the next higher degree condition of the 233 as a confirming trend strength supporting indicator. All right. Additionally, in the components, we get the trender paint bar or histogram. So on the various platforms, we can either use it as a paint bar study or we can use it as a histogram below. So it's simply color coded, all right, to detect and identify the setup more readily. Now, this is not really a red light, green light, yellow light type system, but it does help identify visually what the conditions are in the trade setup. Okay, looking forward. All right, it's a conditional setup. I knew that would happen. Okay, I knew that would happen, that the phone would ring. All right, hold on just a second. Okay, sorry about that. All right, so it's a conditional trade setup, and there's no single bar type for entry. So such as the premium and discounts, we have the alert bar that we paint, okay, white on most of the charts. And there's really no single bar like that. Although we can use the right side pivot rule, okay, for an entry condition or structurally. But it is a conditional setup. So what we're looking for is we're looking for the price to be at a key important inflection point, and then the market holding support or holding resistance, and then starting to shift the condition. If it's an uptrend, we're looking for a condition to shift negatively, and that will tell us that the market now is in the process of at least a correction, all right, beginning, if not a full reversal. And then the ATR stop is going to be used to identify the structural point break, all right, in price. So you'll see that when we take a look at the charts as well. All right, so the stacker defined. Now, there's a lot of relationships here, okay, and we'll just simply go through them one by one, but more importantly, you'll have these slides to review back, and when you're looking at the charts, you'll actually see the various relationships in terms of how the colors shift on the paint bar studies. But the bull stacker full condition is simply when the 13 is greater than the 34 and the 89. So the 34 is also greater than the 89, so that's in that stacked condition. The bear stacker, of course, is the opposite, 13 below 34, below 89. All right, and the bars or the histogram will be color-coded accordingly. Now, that's when the bull stacker and the bear stacker is in its full condition, and that can be at a extended part of a move, all right, that the conditions are true. But really what we want to get is not when they're fully true and the market has made, some sort of an extended move. All right, that's usually when we get discounts or premiums forming along the way. But really what this is about identifying a trend shift. Okay, so from bullish to bearish and vice versa. So there's a key transition phase that occurs, all right, during this period. And that gives us an early warning, all right, of a potential shift, all right, of the trend condition. And that can simply be identified using the Trender paint bar histogram. Okay, so let's take a look at the bullish shift first, all right. And again, this will become a little bit more apparent when we look at the charts themselves, but just go through the mathematics here for a moment and try to visualize this. All right, so when we're getting into a bullish shift, the market condition prior to the bullish shift is in a bear condition. Okay, so the paint bars are all red, all the moving averages are stacked, okay, in a bearish formation. All right. So when it starts shifting, and typically if you visualize price being at or near an important support level, and then we're starting to get a move off of that level, okay? What will happen first is the 13 will cross above the 34, okay? And that's a condition there. The 34 will still be below the 89, and the 89 is being our proxy for trend, so the trend is still down, though weakening a little bit the strength of a downtrend. And so the 13 will cross the 34 first, all right, and the 34 will be below the 89. So what you'll see on the chart is, or the histogram, is you'll see a dark red condition rather than a bright red condition. Okay, so that's telling us that bearish condition that's in effect is beginning to weaken. All right, as the trend starts, or the shifting of the trend starts building more momentum, right, and buyers starting to come in and looking for opportunities to buy the weakness, all right, the 13 will still remain above the 34, but now the 13 will cross also above the 89. But during that period, the 34 is still below the 89, okay? And if you recall, the 13 EMA is what we refer to as the lead line. So it's really that 13-34 combination that's really going to be the most important view here. The 89, it's going to take some time, for price to get fully above the 89. But once the 89 has shifted from a bearish trend condition to a bullish trend condition, then we want to be specifically trading from the long side of the market at the time. So this is the transition period that goes on with that. And during the cyan phase, okay, we can get pullbacks. All right, the cyan phase also allows us to take a more aggressive entry. Okay, remember it's conditional here, so there's not any specific paint bar that's going to say, okay, that's the bar I want to key off of. All right, so when it's cyan, the condition is improving even further. All right, so you can say, okay, let me, if you're a multiple contract trader, okay, I'm going to put one on. All right, and then finally, when you get a full stacked condition, and many times when that occurs, we're getting a pullback, all right, in price. And then again, that's going to be our first pullback type opportunity, and simply we call that the stacker condition. Right, and that's when the 13 then ultimately crosses the 34 and 89, but now the 34 has also given way, and now it has crossed above the 89 as well. So now we have a full stacked condition in effect. Once that occurs at that point, and this generally on the tick charts that we use, 750, perhaps even a little bit more sensitive at that 377, okay, this is going to give us an insight of a shift in the demand supply equation, all right, before the institutional type trader that uses primarily 5-minute bars for their entries. Okay, so this is going to even go a step further and give us an insight of what's happening inside those 5-minute time slices. Okay, now on the bear shift, again, I'll be a little bit quicker on this one so we can, get to the charts. But simply the bear shift is the opposite. Okay, so now you have a bullish condition underway, right? All the paint bars are histogram. Prices made a move up to a key resistance supply zone, and simply everything looks bright green and everything looks super. But now we're starting prices starting to tail off from the high, and price gets below the 13. Remember, the price is always going to be the fastest. All right, so it's the relationship of price relative to the moving average. Now, if you recall from some of our prior educational seminars, the moving averages, people don't seem to understand sometimes what these moving averages represent. Okay, they're a representation of a value, all right, over a period of a look back. So 13 bars, whether they're 13 tick bars, the 13-day bars, okay, a 13-bar period, that is what people look on a 13-bar average value, okay, 34 average value, okay, and of course 89. So on the bearish shift, prices at a resistance or supply zone starting to weaken. Prices below that 13 coming off the highs, it starts pulling the 13 down, all right? And again, since exponentials are weighted to the most recent action, that's what gives us a more timely signal of what's happening. So when that 13 is below the 34, okay, it's going from bright green to dark green. So that becomes an early warning of, hey, hold on, we've peaked out. All right, and the price is starting to pull back here for us. All right, now again, just like the bullish shift on the reverse side, the 34 will still be above the 89, and the 89 will begin to start flattening out. Okay, the slope. I have a note here on the right-hand side that the slope of the moving averages are very, very important. All right, and when they're in a very steep slope, they act as dynamic support or dynamic resistance. But when they start to flatten out after price has run its course to a particular level, okay, then those moving averages start to flatten out. They don't act as support as readily. Okay, so we need to make sure they're back in alignment in order to get back into an aggressive trade. But as price is coming off the high, the 1330 is below the 34, 34 still above the 89. Now as that condition continues to weaken, all right, 13 then becomes still below the 34, but now it's crossing below a more flattening 89 EMA. So now that turns the conditions to yellow. Now when we're in that yellow condition, similarly when we were in that cyan condition on the bullish side, we can start looking to take aggressive trades. All right, positioning. So again, multiple contract traders can say, I'm looking to, all right, I'll put one on and I'll wait for the next pullback, okay, to add to the trade. All right, again, this is a transitioning type trade. It's a conditional trade. So, we want to just use the opportunity to say, hey, the market is weakening. If you're not even looking to take a trade, if you're just looking at it from a standpoint of determining that the bullish uptrend or bearish downtrend is now in the process of shifting, that also can give us a signal if we have an open position to take it off finally. Okay, so we can use it as a management tool if we have an open position to take our final profits from the prior position, closing it. So it's very good for that. And then ultimately when we get the bearish full stacker, all right, the condition is 13 below 34 and 89, and now the 34 has now broken below the 89. At that point, histogram and paint bars are bright red, and we are off, and now the market is in a full stacked bearish condition, and we want to sell every bounce until that repairs itself or finally runs its course to the downside. And we don't know whether or not that how deep it's going to extend. It doesn't give us any predictive, but it does give us a conditional, okay, of what's happening out there. All right, so let's go to the charts. I got one bear example and one bullish example. All right, and that will help give us a little bit more clarity to those definitions. All right, so the chart will come up in just a moment, and we'll take a look at the bull stacker first. Okay, so you should see now the bull stacker, and we'll walk through it. Okay, and so as you can see here, let me see if I can get a pointer here. You can see here we have a bearish condition. We have a downtrend, so that's the initial condition. All right, and you can see here coming into an important low, we had some premiums that were firing. All right, and those were valid premiums at the time. Okay, so price puts in a low. Finally finds some sort of support there, key level, and then the price bars start, rallying here. Okay, so there's enough strength now, all right, coming off this low, that it forces, as prices are moving higher here, it's forcing this white line, which is the 13 EMA, to start crossing right here above the 34. Okay, so that shifts the paint bars to a dark red scheme. Now this is important because at this stage, in this move down, okay, this is the first time. All right, and it won't always look perfectly like this, but this is the first time that the 13 has decisively gotten above the 34. Okay, changing the bar color from bright red to dark red. Here, all right, it stayed primarily bright red during this premium. Notice here as well in the downtrend that the slope of the moving averages, okay, was still fairly robust, okay, the angle. But notice here, as we come off an important low, 13 gets above that 34. Now look at the slope of the 13 and the 34. They're both moving up. Okay, so that's going to be an important part of this transitional condition. Now we don't, at this stage, we don't have a full bullish stacker. All right, we do have a beginning of a transition, all right, stage, but we don't have a full bull. All right, so this is at a point where really aggressive, traders, all right, will say, all right, I'm going to take a long here, because now as long as that 13 stays rising above a rising 34, then this isn't really for sale anymore. Okay, the pressure now is beginning, all the buying is beginning to come back on a net basis, enough to keep pushing prices, slowly, but up in the up direction. You'll notice here that we got a premium signal as well, and that one was a failed premium, or didn't execute, because the conditions of the moving averages, again, we're using that 13-34 combination as a filter. 13 were now being above 34. Okay, we would have to then wait for the 13 to cross back down through that 34 to have this premium be more of a valid premium. So this would be a non-executed premium, just not the right condition. All right, so now as strength is coming in, you can see here transitions, and sometimes the transition from a dark red to a cyan type color, okay, comes in pretty strongly, all right, and pretty briskly. So there's only a few bars there. Sometimes it takes a little bit longer, all right, but the transition is still the same. 13 crossing above 34, and it's above crossing above 89. So now that shifts the condition to even a stronger bullish. And then ultimately what you'll see here is you'll see an ATR point break. Okay, so we can stop by and come here step by step here. So off the low, beginning the transition, 13 crosses 34, then ultimately 13 crosses 89. Okay, and that gives us that cyan color. And as it continues to gain strength, strong enough that not only does the 13 above 34, the 34 now crosses above the 89 right there. Now here's the rub. Okay, moving averages are lagging, all right? And in their lag, there is value to that, because you can, take a vertical line and you can say, well, this is where everything crossed, and where is price at the time? Well, shit, price is way up here. Okay, well, what good does that do me now? Well, the idea is we want to have the conditions in place for the pullback. And most of the time, we'll get a pullback. And so we want to buy a pullback. It's not about getting the lowest price. As I mentioned earlier, you could play aggressively in the dark red region as it's crossing into the cyan. You can get very aggressive here in this area here that I've circled. Okay, and again, a lot of the members in the membership, are aggressive. Okay, so they want to, they're willing to take a little bit added risk in order to get a good location. Others, on the other hand, will wait for the first pullback, okay, following a full shift in a stacker. So by doing so, you're not really giving anything up, okay? You're just making sure that the market is in the proper position for you, all right, and that the market has indeed broken the ATR, the bearish ATR here, okay, and we refer to that as a point break, okay. The filter that we use for the ATR in here, I won't go into it here, but the filter that we use is very, very good, and a ATR shift or a point break shift tells us really that there's enough strength in price that in fact it broke an average true range value, okay, and that's a very positive structural development. Okay, so the trend of bars here displays the bull shift, all right, in development. So dark red, cyan, and then full stacker green. So 13 above 34, above 89. And notice what's happening here. These lines are diverging. Okay, in other words, they're going in the same direction, but they're spreading out from each other. So there's a divergence there in the lines themselves rather than a convergence. Okay, that's going to be important as well. So how do we want to trade this? Okay, so one of the ways is, as I've already mentioned, for the aggressive traders, buying that area of the transition when the 13 is above a rising 34. The secondary and more conservative approach is going to be waiting for that first pullback. And sometimes the pullback can be deep, sometimes it can be relatively shallow, but in either case, it's going to look very similar to what I've displayed here. There's going to be, a pullback type. It looks similar like a triangle. Now, how do we want to enter that? Very simple. The technique is used whether it's a stacker condition, whether we're trading off of a key price level in a sideways range, or if we're in an uptrend or downtrend using a premium or discount. Okay, the entry technique is called the right side pivot rule, RSPR for short, and the RSPR, I've highlighted this in where the red X is. Okay, so the red X is where going to be approximately where your entry point is going to be, and your stop is going to be below the initial low there. Okay, just following on that pullback low. This keeps your risk small, under control, probably no more than about 2 points. All right, but now since we have a definitive trend direction shift, okay, the market now is in an upward bias, and so now by entering there, you virtually, in many cases you won't have any heat. The price is above a rising 13, and all the conditions are in place. So then it's just a matter of using the management technique, and again, using the management technique and use an ATR trailing stop, which is the blue line here, or you can use trailing EMAs. Okay, you get to the risk-free point. All right, take something off. Now you're in that risk-free trade. Then you go into a management mode, and the management mode you may want to use the ATR stops, as a good, or the 89 trailing as a condition as well. All right. Secondarily, you normally get another opportunity. Price pulls back, all right, at it around the 34. And again, same entry technique. Use the right side pivot rule. Identify proper location for it, all right, and I've marked it there on the X. Okay, so pretty straightforward. All right, it's not. It shouldn't be too difficult to to walk through. All right, but it does take, as with any technique, it does in trade setup, it does take some, work with and looking at the charts a little bit more, in a different way. It is a transitional, so it is a conditional trade rather than, like I said, the premiums, the discounts. All right, let's look at a bearish one. All right. On the bear stacker side, okay, there's the slide there. And again, it's going to be the opposite, but let's walk through this. All right, we have bull condition to the upside. All right, so we get a trend up, and as you can see here, we have a couple nice discounts that had fired that were very profitable here on the upside. But price finally reaches a high of some sort. Again, I don't know what this particular value was important for, but reached a high. And price pulls back fairly aggressively off of that high. All right, enough so we get an ATR shift. All right, again, a point break. So that will be one of the checks. One of the, again, I put these green check marks, all right, as step one, kind of step two, what to be looking for. Okay. So price moves below the ATR, right? Certainly pulls the 13 EMA down, right? And again, this was a pretty aggressive shift. So as you can see here, as the 13 crosses down through the 34, the trend of paint bars just simply turns darker green, all right? Beginning of the transition. As price continues to weaken, 13 also gets below the 89, gives us a yellow bar condition. Now we seriously have, at this point, okay, we have enough weakness, because generally when those yellow bars form, you're also going to get that ATR point break. So there's enough energy now to the downside, and many times you'll see that this low transition point where the yellow bars occur, okay, on the bear one, you'll see that it's taken out a prior pivot. So here's a discount at 79 quarter. And you'll see that the low here exceeded the low of that. So that becomes a new swing low. Okay? And so simply, once we're in that yellow zone, it's pretty much a foregone conclusion that we're going to get a full stacker condition, which means that the 13 will blow 34, 34 will cross below the 89. It'll shift the bars simply to red. Okay? So that trend of bar display is the bearish shift developing, and so we'll get a little bit of a pullback. So again, this is the first pullback condition within the context of a shifting new downtrend. All right, and what's our entry technique? Right side pivot rule. Okay, right side pivot rule, and that's where the X is. So once the pivot forms and it's coming back down to the low side, we want to perhaps use a stop order, all right, to enter, or we can use a market order to enter. All right, that's the choice of the trader. But generally, you won't take very much heat, if any. And again, the same technique as premiums or discounts, or level trades. And then in this example here, you can see how it continued lower. We got a little bounce again, secondary bounce, and then right side pivot rule, okay, in play again. So we don't know how far this is going to go, but we want to get on board. Now this all takes place within the context of a 5-minute bar that most of the traders out there use, the institutional type traders, the bigger money traders use. Right? They don't use tick charts. Right? They use primarily 5-minute charts. So we're seeing inside those time slices, okay, that it takes a little bit longer for them to identify a true trend shift. We're getting a little bit of an edge by seeing the development of it early. Now, again, tick bars can be very erratic. I mean, you can see kind of the shapes and sizes of them, but this is why we want to use the moving averages to smooth out that action. All right. So simply, that's the structure of the bull and bear stacker. All right. It's a conditional trade. All right. It's a relationship of these three moving averages. All right, and it develops in the exact same way each and every time. All right, so these are solid examples of them, but there are other times where they're a little bit not as clear. Now, the 233 EMA, it's not shown on these particular charts, but the 233 EMA is a supporting, it's not one of the primary EMA conditions, but it is supporting. So in essence, what you would be seeing here is you would be seeing a trailing 200 EMA, okay, and it's be much smoother than this 89. So 89 is our primary proxy for trend. We always want to be trading on the same side of that 89 until we reach key levels, support and resistance zones, okay, where price starts showing some weakening conditions. Perhaps there's some divergences within the indicators, okay. Other things that we may look at, we may look at one of our sign stochastics, all right, on the 5-minute chart, showing us a deep extreme condition, okay. So we'll look at other factors beyond and above the execution charts, all right, to help us make our decisions there. But here it is, very simply, okay, laid out, the bull and bear stacker, okay, and we want to, practice this stuff on a day-to-day basis. Again, easily enough, we want to try to get these shifts, and one of the key factors is this ATR shift, okay. This is really telling us that there's enough energy in price to shift it. So we're not really moving average traders per se, but the moving average traders are moving averages are showing us a condition that we would not normally see, all right, in the price structure of tick bars. So we're trying to smooth out that action, and it's where price is relative to a rising or descending 89, 34, and of course the 13 is our lead line. And so we want to be watching where that sucker is going, each and every time, okay? So that's it. That's the bull and bear stacker in a nutshell. Not much more beyond that, okay? Just simple disclaimers here is at the end. All our trade simulations and everything is just, hypothetical, but that's it. Any questions? It's pretty straightforward. All right, it's going to be, this was a short class here today, but I just wanted to get the basics of this, and then what we can do in another future class is once everybody in the membership gets an opportunity to view the recording, we can come back and look at it a little bit more closely. But I think once everybody gets a core understanding, when we look at them through the course of the day, okay, we'll speak about them. So this way, I'll get the recording out as soon as possible to everybody, and then everybody will be able to spend some time. It's only been about 34, 35 minutes or so. So very short presentation. I didn't expect it would be taking much more than this, and I wanted to get the core of the concept down. Okay, so that will be it for us, and let me just conclude the recording here.